Morning, how are you? Happy Monday. I hope you had a wonderful weekend. Still a little chilly here in May, and hopefully that changes soon for the long weekend. But I would like to talk to you today about should Ken transfer his pension? This is a question you might come across, so I thought I would share some information for now or in the future when you could be facing this decision yourself. So, that's a big question. Should Ken transfer his pension? We don't face this decision very often. It doesn't occur that often, but the times that it will occur is when you leave a company that has a pension plan, or you retire from a company that has a pension plan. Those are the two main times that you will come across this. So let's talk about types of pensions first. So there's different types of pensions when you work for a company, if you're lucky enough to get a pension. I wish everybody got a pension, but not all companies offer that. So the first one is a defined benefit. So a defined benefit plan is an employer-based program that pays benefits based on factors such as length of employment and salary history. So when you're working for a company that has defined benefits, they can tell you what your benefit will be when you retire from things kind of basically staying equal from where you are in your employment now until you retire. If you have those things, you should be getting a statement fairly regularly, probably at least every couple of years or so. These pensions are defined benefit plans. Pensions are defined benefit plans. This is in contrast to defined contribution plans, which we'll talk about next. And benefits can be distributed a fixed monthly payment like an annuity, or a one-time lump sum payment might be offered. The surviving spouse is often entitled to the benefits if the employee passes away. And the second type of pension plan is a defined contribution. So a defined contribution retirement plan allows employees, so you, to invest pre-tax dollars in capital markets where you can grow tax deferred until retirement. So just like RSPs, but these are through a company. And hopefully in your pension, a company matches some or all of your contributions. They're commonly used by companies that are trying to encourage employees to save for retirement. But unlike a defined contribution, there are no guarantees. And participation in this could be voluntary and is self-directed. And self-directed means you choose the investments that your pension is in, which can be kind of intimidating for some people. And really, you need to make sure you take the time to figure out what's right for you. So also with a defined contribution, you might have access to it after a vesting period. So like a savings account, it's a retirement pension, defined contribution. So the vesting period is the time an employee must work for an employer in order to own outright employee stocks, options, shares, or tax-deferred retirement plan. So if you work for a company and they're contributing to an RSP for you or matching it, you might not have access to those funds until you've been there for a year, 2 years, 5 years, whatever the employment contract says. And at that point in time, you might even be able to withdraw completely if it's accessible, or it might be locked in until retirement. So there's different combinations there. So choices you are usually offered when you leave a company. So you're usually given some paperwork that you have to decide what to do with your pension. And these are some common choices that are offered. So one, you leave the pension as is. So it stays at the company where it currently is with whatever benefit company is investing in it for them. Or you can transfer a pension to a new company's pension plan if that's offered. It's not always an option. Or maybe the new company doesn't even offer a pension plan. Or you can transfer to a locked-in retirement plan like an RSP or a locked-in fund. So it might be a little different choices that are usually offered when you retire from a company. So usually you're given a choice of annuity payments, which is a series of payments made at equal intervals. There could be different options when it comes to these annuity payments. Sometimes there might be a guarantee of 20 payments or a guarantee of 50 payments or whatever, because at the end of the annuity, if it doesn't pass on to the spouse or partner, the money's gone. So it's just used up. So that's where the guarantee comes in. So if it says you're guaranteed for at least 20 payments, that means at least, even if you were to pass, that the annuity would pay out at least 20 payments before it's dissolved. And there's different variations of that. And with annuity payments, you can have it so the survivor is included in that, which means the payments are a little bit lower because, of course, it's spreading over 2 lives instead of 1. So lots of options there could be offered. And then there's a lump sum transfer. So this is where you pick up the whole pension as is and transfer it to a company you wanted to invest with, or use the funds to invest. But knowing that you're not able to withdraw all the money, because that's a common question I get all the time, there are annual minimum and maximum withdrawal amounts that are set by the government. The maximum annual withdrawal limit is intended to maintain a retirement income for the fund or account holder or their survivor, as the case may be, until at least the age of 90. So there's, like I said, there's certain percentages set out. So an example for 2022 for a 60-year-old, it would be 3.33% minimum you have to take out of your locked-in plan, up to a maximum of a 6.85 that you can take out. So there's a bit of confusion. People think they can take the whole lump sum and cash it out. And of course, the money you're taking out of your pension, whether that's annuity or a lump sum transfer, you have to claim as income and pay taxes on it. So some considerations when kind of working through these different options is, what does your current retirement income look like? Have you sat down to figure it out? Like, what should you be anticipating to get with CBP and old age security and with other pensions and other income you have? If you've got a very strong retirement income already, maybe you're not so worried about getting the pension or the annuity income, because you know that you've got enough taken care of, and you can look at maybe doing a lump sum with the minimum withdrawal rates, because then you can play a little bit more with it, or you can put it up to the maximum when you want to and stuff. So that's something you want to look at. Do you have someone that counts on your income? So like we talked about before, with annuity, you can put your partner on. So, you know, if something happens to you, that the annuity partially or will continue on with your partner. So you want to make sure you consider that. And some people move the lump sum over and just take minimums out with the hope to maintain the principal, so they can leave the principal to their partner or children or whoever they want to pass the money on to. The third is to think about, what's your risk tolerance? Are you going to be okay not knowing what your returns are going to be if you moved it all over in a lump sum and invest it? Because as we all know, markets go up and down, and this can be really tough on some people. They just agonize with the potential roller coaster ride with investments, and would prefer to have an annuity where they know exactly how much they're going to get every month, so they don't have to worry about it. So definitely something to weigh when you're making a decision like this. And will the decision impact other income? And I'm going to use the example of old age security. So I don't think a lot of people know that if you hit a certain income, when you're retired, that old age security can be clawed back. So if you're making 79 in 2022, if you're making $79 and $54 every year, you'll start to get some of your old age security clawed back. So of course, the higher above that, the more clawback is. And virtually it could be to nothing that you get. So when making this decision, do your homework, really educate yourself on this. Work with your financial professional to look at your options and weigh out what is best for you. You can't usually reverse the decision, so it's worth your time. But though I will say, if you move a lump sum over, you can change it to annuity with wherever you're investing to in most cases. So you haven't totally locked that one off. So I just want to say thank you for listening. Hope that gave you some clues, and Ken decided to transfer his pension after we worked through all these different things, but it's a different answer for everybody. I hope you have a wonderful week, and we'll see you next week. Thank you.